So this morning I am joined by Jen LaRue, who is going to cover the lease standard year 2, and Amy Staunton, who's going to cover the credit loss standard, overview of that. And then at the end, I'm going to cover some miscellaneous updates, some other topics which aren't as pressing or as prevalent as leases and credit loss standard is. And also there is an update on the new firm guidance. We've been waiting for that for a while, and that's finally out and official. So we can actually tell you how that's going to impact you in the future. So without any further ado, I'm going to turn things over to Amy and let her introduce herself.
Good morning. Thank you, Matt. I'm happy to be here with all of you. I'm Amy Staunton. I am a director and a consulting CFO in our practice that has a new name. It's called AAFC, which is Outsourced Accounting and Fractional CFO Services. For those of you who were familiar with our MAS department, Managed Accounting Solutions, that's now become AAFC. We love acronyms. So in my role, I work with about 20 different not-for-profits in a fractional CFO capacity. So for some of our clients, we are their full accounting and finance function. And for others, we insert ourselves into the client's process and perform a piece of their finance or accounting function that they don't have in-house. We're using wired headphones today, so please forgive me, mine's not going to stay in my ear the entire time, so I apologize that I keep putting it in. But before it fell out, I just wanted to mention that. And I'll turn it over to Jen for her introduction.
Hi everyone. My name is Jen LaRue. I am an assurance manager here at AAF. I have been with AAF for 9 wonderful years that have gone by way too fast for my liking. I work in both our for-profit and nonprofit practice, but primarily with the education practice nonprofit. The last 2 years, I have been a member of our lease task force, so helping clients and team members go through the nuances of the new lease standard. So as John mentioned, this is my first time presenting here today, and I'm very excited to be kicking it off. So with that, I will kick off the seminar today with the year 2 considerations for leases, everyone's favorite topic. All right. So before we get into the material, we just wanted to do a quick pulse check to see how's everyone feeling now that we have 1 year of leases under our belt. Are you feeling like a lease pro? Comfortable enough, still could use some more guidance, or do you just try to avoid signing leases altogether? All right, let me take a look at these results.
Good way to kick off a session, kind of see where everybody is at.
Is everyone getting the, oh, there we go. I wasn't seeing the results, but now I can. All right, so we do have a lot of people that are responding comfortable enough, but still a good amount that could use some guidance, which is really what we were expecting. There's a lot of nuances to this lease standard. It was definitely, as was mentioned, we've been talking about it for 6 years now, and even after a year into implementation, still want to go over some important reminders with you. So hopefully after today, you'll feel even a little better. All right, I'll give it another couple seconds to get in your poll. All right, moving on. So today we will be going through focusing on lease modifications and new leases and what to kind of consider there. We've received plenty of feedback from users of the financial statements that it doesn't always seem like there's a whole lot of benefit to this standard, but it's here to stay. So we really want to make sure that you're prepared and heading into year 2. All right, so lease modifications. What is a lease modification? So really, it's any change to the terms and conditions of your lease contract. This could be in scope or even in just the length. It could be additions or removals of right-of-use assets. So there's a couple things that you really want to keep in mind. The first one, when kind of looking at an addition to a right of use asset, so you want to ask yourself, does the modification result in a separate contract? So to answer that, you have to understand, are you adding an additional right of use asset to your lease? It might be a lease amendment, but are you getting a new asset? So a good example I like to use, and that I've seen in real practice, is say you have one office suite at a building, but then your lease is amended to have a second office suite because you're growing. That's an increase in square footage. So you would account for it as a separate contract if that new suite has its own price assigned to it. So if the first suite is $200 a month and the second suite is $500 a month, you can account for that as a separate contract, and you do not need to revise your original lease, which can be helpful. So if the answer to that question is no, or even if it's both, so maybe you do have a new asset and a specific price for that asset, and maybe you have, but maybe the term of the length of the lease also changed. In that case, the answer is no. You should just remeasure and reallocate as one new lease. And then for the modification, there's also the removal of right of use assets. So in that instance, you want to ask yourself, does the modification fully or partially terminate an existing lease? So thinking of that square footage example again with the office lease, if you are decreasing your right of use asset, that's when you'll want to recognize the changes in the P&L. And if the answer to that is no, then you would just remeasure the lease liability and adjust the carrying amount for the right of use asset change as well. All right, so this is really a high level overview, but if you do have any questions, like we've mentioned, put them in the chat and we can go through those later in the later session. All right. So next, there's new leases, also some reminders we wanted to go through. The first one being, do not forget that any new leases that you enter into during year 2, you need to assess for classification. So you might remember at the time of the adoption, there was a practical expedient that you could elect to not reassess existing leases. So what they were, if they were an operating lease under the old standard, they could remain an operating lease under the new standard as part of that practical expedient. But now this is just a reminder that you do have to assess for any new leases that you're entering into. It's very small, but I did add, just for your file, so you can go back and look at this as a helpful tool, I added a flow chart here to kind of go through the criteria of what's a financing lease versus an operating lease. It's very similar to the criteria under the old standard. The one real difference being is the economic life and the present value criteria. There's really no bright lines in those percentages anymore. However, the standard did say that it is reasonable to use the old percentages of 75% and 90%, which were under the old standard. So really no changes here, but just need to make sure that we are not forgetting that step when signing new leases. All right. So the second point I wanted to call out here is the discount rate. So you might remember that there was 3 different options for the rate that you use in your leases. The first being the implicit rate. If that's stated in the lease itself, you are required to use that. The second was the incremental borrowing rate, which many of you chose. And then the last one was the risk-free rate. So for those of you that chose the incremental borrowing rates, just a reminder that you do have to obtain a new rate for new leases. You cannot continue to use the rate that you obtained at the time of the adoption. This rate is really unique to each lease itself. It almost works like a debt agreement. So the interest rate that you use should match the total obligation and the term of the obligation as well. So it's really unique to each lease, and you have to make sure to obtain those new rates as needed. All right. And then, so the third one here is a reminder to record your lease at the lease commencement date. And that date is the date that the asset is available for use by the lessee, so by yourself. This can be different than the date that the lease is signed, and it can be different than the date that the lease is even started. A an example we see often would be if there's a construction period to the lease. Sometimes the construction period has begun, but if you don't have access to that lease yet or to the asset yet, maybe it's a building, then you wouldn't record the lease yet. That wouldn't be the commencement date. Number 4 is vehicle leases. Just something that we've seen in practice is, we all know that vehicle leases, definitely you're given an interest rate when you're purchasing a car. Leasing a car, you're given an interest rate. But what we're seeing is when you get a copy of the actual lease, it's not listed. So we found it helpful to request this information at the time that you're entering into these leases, and it's very easy to obtain. And then you just can use the implicit rate, which we all know is available in a vehicle lease. And the last reminder for the new leases is to remember to check in on those immaterial leases. Copiers, storage, postage, you all had assigned a materiality threshold in your policy when you adopted the standard. But just as you enter into new leases, you have to remember to look at them in the aggregate and make sure that in total they're not material. Okay.
Jen.
Yes.
Yeah, hi. A couple of questions came in on the interest rates.
Yep.
One is, for the incremental borrowing rate, can you default to a line of credit rate?
So no, you should not be able to, you cannot default to any rate that you already have. It really should be unique to the exact term and obligation specific to your lease. And then another question that we often get is, can you use both the risk-free rate and the incremental borrowing rate? So maybe for copiers, you want to use the risk-free rate, and then for your vehicles, you want to use the incremental borrowing rate. You can't do that. You can't mix and match. So that's something else I wanted to point out. You really have to take one approach, and then if you do want to change it, that would be a policy change.
So you have to do this with all leases consistently.
Right.
Yeah, because I know sometimes I get the question, I'm using risk-free rate for this, but this one here, I like to use incremental borrowing rate. You really can't do that, right? You need to have consistent with all your lease agreements.
Yes, that's correct. Company-wide, you have to use the only time that you could use a different rate is if one lease includes the implicit rate, and then your other leases that don't have implicit rate, you would have to either choose to use the incremental borrowing rate or the risk-free rate. Great. Thank you. Great question. All right. So now I do have a few other reminders, quick reminders to wrap this up. The first being to, if you haven't already, make sure that you are updating your written accounting policy. We had a number of best practice recommendations last year that while we adopted the standard, it wasn't formally documented yet. So just a reminder to do that before your audit. And the second one is this accurate monthly reporting. So what's important, what we're also seeing is many clients are often still recording leases under the old standard or even just cash basis. And then at the end of the year, they're going through and reconciling and booking all of the adjustments to record the lease liability and the right of use asset. Our recommendation here is to really just fully adopt the standard and record the monthly entries for a number of reasons. This is going to help present accurate monthly reporting to the users of your financial statements. But it also will just make your life easier at the end of the year to not have to kind of go back and unwind and figure out where we're off. The next one is just the timing of accounting for new leases and amendments. We want to be definitely timely. So as you're entering into new leases, start thinking about how you're going to do the calculation, whether it's you have your own software or you're going to reach out to us for consulting. We want to do that really timely and well in advance of the audit. The next one is the consideration for potential embedded leases. So you might remember we had a few audit procedures last year when we adopted the standard to search for embedded leases. And an embedded lease is basically a contract that you are getting benefit of an asset. So a good example would be maybe like a software asset, but it's not really called a lease. However, it's a lease in disguise. And under the standard, you are required to do a calculation for this. So when you're signing and entering into new contracts, just have that little light bulb on, like, ooh, could this qualify as an embedded lease? And should I reach out to AAF for some consulting here? So we're also not finding any of these during the audit that need to be adopted. And the last reminder here is just the reminder that there is software available that can be definitely worth the investment. We have found that many clients that have invested in software have found it very beneficial. There's a number of software out there, and we're more than happy to help kind of guide you to see which one could be a good fit for you in your company.
So Jen, any suggestions on an organization that may have done it themselves last year in Excel and it was kind of cumbersome process, what they should think about if they should really do a software? Is there any like rule of thumb or anything you've seen that they should consider if switching?
Yep, great question. So we've actually found that even if you have just 3 leases, it can be very beneficial because these leases end and then you enter into new leases. So it's an investment that you will have a great return on. The other great thing that comes with the software is all of the disclosures are summarized for you, which can be tricky to calculate manually. So we're finding that it's definitely beneficial. And that, like I said, that is something that AAF, we do have a good understanding of the different types of software and what they have to offer. So that is something we're happy to consult on if you are interested in hearing about some of the different types. All right. And to wrap it up, just one final reminder that we are still here to help in any way that you may need, whether it be lease calculations, reviewing lease agreements, the calculation itself, or again, assisting with software selection. We are here to help. And yeah, I look forward to possibly seeing you in the breakout rooms later. So with that, I will hand it over to Amy to go over credit losses.
Great. Thank you, Jen. You did a great job on your first time presenting.
Thank you.
So I want to talk to you about the current expected credit loss impairment model. As I mentioned, we love acronyms. So this is called CECL. This is what bad debt and allowance for bad debt was previously referred to. I'll get to in a minute. There still might be a little bit of bad debt, but this is the new bad debt. So this has been. It's not advancing my slide.
Amy, this happened to me as well. You have to hit next. You can't pick the slide.
Okay. Thank you.
Yeah.
All right. Thanks. Now. Thanks. So this was effective for public companies back in 2019. So if you are looking for examples of disclosures and how other people have done this, just pick up a public company financial. It's applicable now for all other organizations starting calendar year 12/31/23 or fiscal year ends in 2024. So I know a lot of not-for-profits have a June 30th year end. This will be effective for this June 30th, 2024. Then I am going to skip for a second because I like to give the summary first. Somebody gave me some advice at one point to come in with the punchline so people know how much to listen to what you're saying. And I think a lot of people in not-for-profits think this doesn't apply to them. We don't have bad debts. It doesn't apply. But I just want to let you know that it most likely does. If you have 606 revenue, this applies to you. And I'll go through in a minute, just reminding you what the 606 revenue is. And then it is possible that you might have no allowance, but you do have to acknowledge that there's risk and you have to assess that risk. So you can't say there's no risk, I have zero allowance. You can say I've assessed the risk and I have zero allowance, but you do have to acknowledge that there is some risk there. This is on day one of the receivable. So the first day that you extend credit to somebody, basically by performing your piece of the performance obligation, is the day that this will be assessed. And we are changing, the industry has changed this from what was previously referred to as an incurred model to an expected model. So we're going to be looking at what's our risk in the future. This could result in a lower reserve after you perform your analysis. So if you do your entire analysis and you come out with a lower number, it's not that you did it wrong. It's that you perhaps had a very stale rate that was being used in the past. You could have a lower or you could have higher. I just don't want you to think that if you come out with a lower number that you think that you've done something wrong. And then there will be some changes in terminology and disclosure. All right, so now that I've given you all the highlights, we'll talk about what is the 606 revenue, what is in scope. So these are certain investments. This is contract revenue. This is revenue you've received fee for service. This is membership dues that you receive for a daycare or a school. This is your tuition. If you are a healthcare provider, this is your third-party reimbursements. Then, if that's the case where you get through third-party reimbursements, you'll want to think through what is coming from insurers like Blue Cross, what is coming from private pay. But there's a lot of different types of 606 revenue. There's a few other examples on this page as well. Okay, so now that I've given you a little bit of the highlight, I want to launch a poll. Again, this is for your CPEs. So just let us know where you're at with CECL. Are you all set? You've gone through your analysis and you're ready to go? Do you know what to do, but you're still refining your calculation, gathering some more information and continuing to assess? Do you think, I don't think this, are you saying to yourself, I don't think this applies to me? And again, I would challenge you to really assess if this doesn't apply to you, because I think there is more 606 revenue out there than people think that there is. Do you need help? And if so, we are happy to help you. In my OAFC, which we're still trying to get that new acronym to just roll off the tongue, but in our OAFC group, we would be happy to help with this. You can always reach out to the auditors for a little bit of guidance, but here at AAFCPAs, we are ready to help you with this if you do need help or other. You're just not sure where you stand. So I will let that stay open for just a couple more seconds so everybody gets their CPEs.
While that's launching, Amy, so I think it really comes down to scope, it sounds like. That's really the main point for those who haven't really addressed this yet.
Absolutely. Like, do you have revenue that falls into this scope or not? Do you have receivables, I'm sorry, that fall into this scope or not? Okay, so last call for the poll. All right. We'll keep going. So just to further refine the conversation about the scope. So under 606, you have a contract or an agreement with a counterparty. You identify the performance obligations, assign a transaction price to those, determine the transaction price, assign that price to the performance obligations, and then as soon as those performance obligations are satisfied, you recognize revenue. This ASC starts right when the revenue is recognized. You then assess your expected credit loss on that contract, and you record an allowance. And then hopefully you collect the receivable. If not, you charge it off. So this is right on the heels of it versus just at year end when you assess what's remaining. Oh, and I didn't push next. I just advanced this. Okay. So what is excluded from this scope? 958 revenue is excluded. And again, those are pledge receivables for a not-for-profit entity. So any pledges that you have from a foundation, from an individual, that is not included in this scope. Additionally, loans or intercompany receivables under common control are not included in this scope. They are excluded. Receivables from operating leases, some financial assets, and some loans from defined benefit plans. Those are all excluded from the scope.
Amy, a couple of questions came in on pledges, which I think you addressed, but not in the scope. But there was one question on what about multi-year pledges? Does that change it to be in scope or out of scope?
I'm going to ask you to correct me if I'm wrong, but I believe that is all out of scope.
Yes, correct.
Okay.
Yeah.
Okay, good.
Just to make sure we address the question while you're on that subject. Sorry about that.
Thank you. I just want to make sure there wasn't anything I was missing on that. But yeah, so that's all out of anything that falls under 958 revenue is out of scope. There's a couple key themes I'm going to be making in this presentation, and one is this, that you are reflecting the risk of loss even when that risk is remote. So again, you might do an entire analysis, and you might determine that your allowance is 0. But here's the other key theme: you're going to be looking at past historical trends, current conditions, and future expectations. And I'll get more into that into the next slide. But you're going to do a thorough analysis because there is a risk, and you have to assess that risk. Your allowance might be 0, but there's a high bar to reach that threshold. If you have collateral, that in and of itself does not determine that your allowance is 0. It's part of the overall analysis, though. So is your collateral in cash in your possession, and is it larger than the receivable? That certainly is a piece of this analysis. So then I mentioned that there would be some changes in terminology. So bad debt expense under the scope of CECL is now called credit loss expense, and the allowance is the allowance for credit loss. I did want to mention, though, for those out of scope revenues, like 958 revenue, that will still be called bad debt. Hopefully you don't have any bad debt under a pledge that somebody has made to you. But if you have 958 revenue and you have bad debt, that would still be called bad debt. It's just the 606 revenue is called credit loss. Your first step after you've determined what is in scope is you want to take your receivables and you want to break them into similar pools. So you want to focus on the risk characteristics, which might be credit score ratings. It could be geographic location. It could be, is this to individuals? Is this to corporations? Or based on the size, based on the term, whatever your similar characteristics are, you will take your receivables and you will aggregate them into separate pools, and then you will assess each pool and the reserve that you feel you should have on that pool. Here's an example that on the top, this customer, organization has broken their receivables into what is to be received from corporations versus individuals, and then broken it into what's current versus what is delinquent based on 30, 60, 90 days, 30, 90, over 90, sorry. In the next chart, they've also added the component of geography. And so this is helpful because obviously what is current from a corporation in the US has a different risk than an individual in Europe that's over 90 days delinquent. It's just the receivables are coming from completely different sources. And so you'd want to assess those, the risk of each of those pools based on, like I said, the next theme I keep making. So you'd want to look at your historical loss of your receivables from those counterparties, but you also want to look at current conditions and then what you can predict about future forecast. You also want to consider if your asset base has changed. So when you're looking at your historical information, was this all to corporations, but now you also have individuals? Or was this previously all to US and now you have international as well? So you want to make sure that you are looking at your historical information, but making adjustments towards what your current asset base is. Looking at current conditions. So are economic conditions stronger or weaker than the historical data implies? So if you're looking back a few years, obviously there was the pandemic is going to be very prevalent in your historical data. And for some that received additional funding, or maybe they were in a business that there was a lot of demand during the pandemic, there's going to be different results versus those that were really suffering during the pandemic and maybe had a lot of losses. So look at your historical data and see how that compares to what current conditions are and make adjustments based on that. And then reasonably predict anything from the future that you think would impact this. So are your Are your receivables in a country that's encountering great political unrest at this point? So what's going to happen to that receivable based on what's going to happen in the future? Bottom line, you should look at your historical information, but you can't just say 10% because we've always been 10% without having support. So you really need to go through and recalculate and see if that's the right number for you. Here's a quick example just showing that this company noticed that its credit losses are tied to the unemployment rate. And so they are saying that in year 20x6, the unemployment rate is predicted to be 6%. And so they are going to record a 4% loss rate for the receivable at year end based on historical information. They know that their credit losses are tied to unemployment. And so looking at what unemployment is predicted to be and then applying a loss to that. There are a couple of models to do a calculation, and I'm going to show you two of them. So the first is just looking at aging. And so in the past, this corporation has experienced credit loss rates on these different buckets, the 30, 60, 90, and over 90. But based on current conditions, future forecasts, for example, they think that rather than the historical credit loss rate of the 73.8% they've experienced on over 90 days, they're going to increase that to 82% on that pool. So calculate an expected loss based on the current credit, the expected credit loss rate, and then your total overall allowance is the $20,755 in this example. Another example is to look at the write-offs for each year versus your average annual receivables, and then take an average annual loss. So you look at your loss for each of the previous 4 years and you average that. But then again, you need to add on the component of what you think will happen based on current results and future forecasts. And in this example, in the second bullet, it's showing that there would be a 0.05% increase based on management's belief that the loss rate is going to increase because of increasing unemployment. So this model is certainly acceptable. It's probably the easiest. It's probably the least precise though. But if that is what you think is sufficient for your organization based on the dollar amounts and the risk that you're facing, that's certainly acceptable. Just make sure you document your rationale.
Amy, there's a couple of questions on the effective date, like how far back they need to go. So the example is, say you're June 30, 2024 fiscal year end, and you're presenting comparative financial statements in your audit to June 30, 2023. Do they have to go back and restate 2023, or do they just do this beginning in 2024?
That's such a great question. Thank you. So you are going to look starting on, if your fiscal year end is June 30th, 2024, you are going to look at this starting July 1st, 2023. And you are going to say, okay, this is my receivable pool on this date. This is my allowance on this date. And if that is different than what your allowance was on 6/30/2023, you are going to put the adjustment through equity or through net assets as a cumulative adjustment through equity. Then you will look at your fiscal year end for your fiscal year from July 1st, 2023 through June 30th, 2024. And again, you want to make sure that your balance is accurate as of June 30th, 2024, but you also want to make sure your expense throughout the year on your statement of activities is correct based on that full year of ins and outs based on your receivable activity. So some disclosure, you are going to have your disclosures just listing your policies, and there's a couple examples next. This is, with pretty standard, you would just say what this CECL, what this is, describe it briefly in footnote 1, your summary of significant accounting policies. And then if your adoption is material, you are going to note that the cumulative adjustment that you recorded through equity, what that was, or you're going to say that we adopted this and the impact was not considered material and it has resulted in new disclosures only. Excuse me. You'll also present a roll forward of that account from the prior year in a table. So some other quick notes. Make sure you're involving others in the organization in this analysis. This is not an accounting only issue. You would want to make sure that you're including senior management. You're including a credit department if you have one. I would include IT if they could pull some reports for you and help automate this. And then you can switch models in the future. If your receivable base has changed, if you have, again, in that example, if you started adding international or you started adding individuals or your receivable base has changed and now you want to change your calculation to further refine it, you definitely can do that. Make sure you document all this in a policy, in a memo. You'll want to provide that to the auditors so they can know the thought process behind your ending balance. And then the analysis does include unbilled. So just because you haven't sent an invoice doesn't mean that you haven't extended credit. So this includes your unbilled as well. And then, as I mentioned, consider not only the balance on your fiscal year end, but your expense during the year as well. Okay, and with that, I will turn it over to Matt for some additional accounting topics.
Thank you, Amy. Great overview of CECL. So I think we have some of the topics on here. We're kind of running out of time, so I want to make sure we spend enough time on uniform guidance, because I think that's the most significant update for today. So I'll just kind of briefly mention some of the other ones. If anybody has any crypto assets, any digital assets, a new standard came out, and this is basically just we've been working on for a while for the accounting industry really to come up with a way to measure them that it's more at fair value than as an intangible. So this standard just came out. So if you do have any digital assets, crypto assets, or think about getting involved in them, these are the requirements. This is effective for calendar year 25, fiscal year 26. You can adopt it early. So basically, it just moves it from an impairment model, historical cost basis, to a fair value under certain requirements here. So if you do have this situation, just suggest you reach out to your AAFCPA's team, and they can kind of walk you through this process and this new standard. The reference rate reform, as you know, this has been out for a while. Just a reminder, this standard is still available. This ASU, when you do adopt, move from LIBOR to another rate, and the sunset was moved to December 2024. So there's still some time to do this simplified method if you do change your rate. And business combinations, just a reminder here, this is effective for calendar year 24, fiscal year 25. Any business combinations that contract assets and contract liabilities have to fall under 606. So uniform guidance, I know there's been a lot of talk about this for a while, a lot of things about threshold being too low, some other changes. Well, the good news is the final guidance was finally issued beginning of this month. So it has become official. So these things I'm mentioning today are effective this October 1st, 2024. And the way uniform guidance works, once a standard is issued, it's for years ending after that date. So if it's issued on October 1st, 2024, the first main fiscal year this will apply for will be December 31st, 2024. So if you're a June 30, 2024 year end or September 30, 2024 year end, you'll still fall under the old guidance. This will be effective for your fiscal year 2025. So the main thing for this was to increase the threshold for when the single audit is required for the 750,000 to 1 million. So that was a jump. Once they look at coverage, how much of the federal funds are they covering? At $750,000, they were covering a really large percentage, particularly during the COVID time when the more monies were coming out. They're getting a very high percentage. They figured it was too high. It's a very big administrative burden for a smaller nonprofit to have a government audit. So they did raise the threshold for that. So that's really the main thing. From an audit perspective, it doesn't change what's considered a type A or type B program or major program determination. Most of the change is really to kick you out from a single audit versus the impact it might have on your audit going forward. So we're not saying a big change there if you still have to have a single audit on the thresholds. One other change that came about was the threshold for when you can capitalize equipment. So the federal government, the current guidance is $5,000. They have increased that to $10,000. if you chose to do that, that's an option. You can't go above 10,000. So for a larger nonprofit, you may be interested in doing this. One thing I would just mention as an FYI, the Commonwealth of Massachusetts, those of you who do business with the Commonwealth and file a Uniform Financial Report, we'll have to see if they do raise that threshold. Right now, they're at 5,000. So if they didn't raise it to 10,000 and the federal portion did, you have to think about the impact that will have on reporting and non-reimbursable costs and that sort of thing. So just keep an eye out for that. We'll give an update when we know more about that in the future. A couple other factors: the de minimis rate, indirect cost rate. So right now, the de minimis cost rate, indirect cost rate is 10%. They're increasing that to 15%. So that's the situation where if you don't want to go through another negotiated rate, such as an indirect cost rate with your oversight agency, you can just not do that and do 15%. So some people right now do it at 10%. Now that would be 15%. But I would think about here is if you're kind of in between right now. So maybe you have indirect cost rate, negotiated rate of 12% or 13%. If this is going to 15%, maybe you might be better off changing to the simplified method in the future, or you may still want to do the negotiated rate. What's something to think about? Then that's something we can advise you on, to reach out to AAFCPA's team, and we can walk you through that process. The other thing is those that give a lot of subawards. So right now, the indirect cost you can charge on a subaward is only the first 25,000. Now you can charge it up to the first 50,000. So that might increase the reimbursement for indirect cost from 25 to 50. So those that have a lot of subawards, this might be advantageous for you to recapture more indirect costs. And then there are some other, miscellaneous, what they call administrative requirements to ease administrative burden. So some things might be helpful, some things relevant. One of the main things here is that it reduces the number of prior approvals. So right now, there's a lot of things, who do direct business with the government, you need prior approvals for. Those will be limited. There won't be as many of those in the future, which is great. And then this is a big chuckle here, that the agency should be more clear and concise in their documentation in the guidance, when they issue guidance. So as we know, things are not always clear and concise, so we'll have to see whether this really happens. But we will be issuing a blog on this with more details in the next week or so. So keep an eye out for that. But again, please feel free to reach out to us with any questions you have, or to the team, your AAFCPA's team. So that brings us to the end of our session this morning. We thank you so much for your time, your great questions, but thank you and enjoy the rest of your session today.
Thank you, everyone.
Thank you.